Ladies and gentlemen, welcome to today's webinar titled Fringe Benefits Blitz for 2021, Taxing and Reporting Fringe Benefits, brought to you by Webinar Planet. This webinar will be presented by industry expert Vicky M. Lambert, and it will be recorded to purchase later in the form of DVD, transcript, flash drive, and digital download. If you wish to ask questions during the webinar, please type it in the question box and it will be later answered by the speaker during the Q&A session. Vicky, welcome to the program. We are now ready to begin.
Thank you so much, and good morning to everybody, or good afternoon, as the case may be. Today, we are focusing on a specific area of payroll, benefits. What benefits can we offer? What benefits do we offer? That's a company decision, okay? Do you want to offer meals and lodging? Do you want to offer the personal or the business use of a car? Do you want to give educational assistance? These are all things that your company has to make the decision. Nobody's required, okay, except with the exception of the health insurance situation, nobody's required to offer fringe benefits. But once you do, you must tax them correctly. So I know we've seen lately in the news where certain people are questioning, Jay, you know, the personal use of a company car was taxable. Who knew? Every payroll clerk in the United States, because that's what we have to know. Okay, we have to know when something is given to an employee, whether or not it is taxable. Now, I have to be honest with you. Sometimes our boss won't let us tax it. Many times I've told my boss, you know, those gift certificates we give out at Thanksgiving, they're taxable. I don't care, we're not taxing it. Okay, but we have to know what the rules are. If your boss decides to go against them, there's nothing you can do, all right, except to make sure that everybody knows your boss made that decision. But we have to know what's taxable and what isn't. So we're going to go over all the different sections where we might fall into some of the more common, okay, fringe benefits. We obviously can't go over all of them, but some of the most common. So for example, section 132 of the Internal Revenue Code is where they throw a lot of the benefits. Length of service and safety awards, de minimis benefits, things like that. Or we have transportation fringe benefits, such as personal use of a company car or a vehicle or an aircraft, or business use of a personal vehicle. We have personal benefits that affect us, like relocation, meals, and lodging. We have insurance benefits, like health insurance and third-party sick pay. And then we have benefits that we just offer, and most time they come out of accounts payable, like educational assistance, gift certificates and cards, prizes, and awards. So we're going to be looking at about all of these different areas in the next 90 minutes. The first one we're going to look at is section 132. Like I said, this is kind of like the garbage can of fringe benefits. The IRS just kind of throws everything in here. Most of the time, most of it's not going to be taxable. If it is, it's usually after a limit. But when you look at section 132 and we look at the area called de minimis means itty bitty, too small to worry about. It's a Latin term, I guess they prefer over itty bitty. It's obviously not as easy to spell as itty bitty, but it just means that what you're doing has so little value that it would cost more to track it than it would to tax it. Okay, but it can't be offered very often. It must be occasional to just a few employees. You could even give it all to all of your employees at once, but you can't do it all the time. All right, and if you know it's coming, then it's not administratively impractical to track it. And second, probably I should say first, most important, is that you can never have de minimis on cash. Okay, cash is never going to be, or its equivalent is never going to be de minimis. All right, we might allow you to pay it, but it's not considered de minimis. It's just considered that in that particular case, you may be able to use it. So some of the things that we consider de minimis, which a lot of them we aren't even using anymore, for example, like personal use of the photocopier. Well, we all have printers at home now. Occasional tickets to something that's not a prize or an award, like opening night at one of the ball games where, you know, the company buys seats or something like that. And as long as it's not a reward, like the top 10 people get to go, a company picnic or a group a meal every once in a while, like a company picnic once a year, a company winter party once a year. Those would be de minimis, but you can't have a group meal every week because then it's not occasional and you know exactly when it's happening. So if you have a group meeting every Friday in your office and you order pizza, technically that pizza is taxable as wages because you're giving food when you don't have to. But you are allowed to give occasional meals for working overtime. And that's where I said, remember when you could give some money and it wouldn't be taxable? If the employee is going to have to work late and you have to feed them in order for them to work late, and you give them $10 to go to Jack in the Box, that would be okay. But you couldn't do it every Friday. You can't say, okay, every other Tuesday we have to run the payroll, so we're all going to eat it. But you could say, the payroll blew up. We got to get the quarterlies done. We're all going to have to stay tonight. Emergency kind of thing. Has to be an emergency kind of thing. Can't be planned. Now, of course, things like coffee, donuts, and soft drinks are considered de minimis. But if you offer donuts every morning, that's not going to be de minimis. Maybe once or twice a month, that would be. Okay. Flowers or, those fruit baskets on a special occasion, using the telephone, though most of us have our own cell phones. That's why I said some of these are old hat that are just never been done away with. If you borrow a company car for a day, one day, you could do that. But if you have it for 2 days, it's taxable. Okay, and you couldn't do that more than once a month. So let's say I took my car in to get it worked on, and I took an Uber to work, and my boss says, well, no, don't take an Uber home. Just take one of the cars and drive it, and and that way you won't have to pay for Uber. So maybe until you get your car back tomorrow. Okay, fine. But if it's going to be 3 days till you get your car back, then no, we got to tax it. Okay. And also, cell phones now are under this. The personal use of company cell phones used to be taxable income. It always was. I don't know where somebody got the idea that it wasn't back in 2010 when the IRS said, yes, these are the methods that you need to use to tax cell phones. And people thought, oh, you're taxing cell phones for the first time. And they weren't. Cell phones have been taxed since cell phones came out. And they were always taxable for their personal use because they were what they were called listed property. They were so expensive that they were on listed property. And Congress was the only one that could take it off that listed property, which they finally did in 2010, 2011. So if you give your employee a cell phone to use for business purposes, all right, let's say you're a cable installer and you have to keep calling in all the time. Okay, is it working now? Is it working now? And then that cable installer picks up his phone and says, hi, honey, I'm on my way home. We wouldn't have to charge him for that. Okay, whereas we used to, but now we don't. But de minimis can never be cash, except, like I said, the meal money. So, or gift certificates, or anything as the cash equivalent. All right. Also, executive perks, which has again been in the news recently. Executive perks are really an area the IRS looks at. Okay. And if anybody's surprised that they're getting audited for executive perks, they have not been paying attention over the last 5 years because basically the IRS has been down on this for a long time. Apartments, condos, vacation homes, boats, vehicles, okay, being given a vehicle and never taxed on it. These are the things, paying your children's tuition, okay, not their daycare under a 129 plan, but children's college tuitions, children's high school to private schools tuition without calling it taxable income. These are all things that can never be de minimis and are always going to get you in trouble. And memberships in country clubs and athletic facilities are all taxable now and have been for a number of years. Okay. Now, the occasional meal money, I kind of gave you an idea of how that works, but it must be occasional. If you're going to do a meal reimbursement, it cannot be considered de minimis if you do it too often. So you have to do it where it's an extension of the employee's normal work schedule. You didn't know it was coming. It was an emergency situation. Okay. The example that the IRS gives us is a ferry breaks down in New York and it's got to be fixed before the morning. So the engineers have, whoever fixes ferries have to go out there, but they also have to eat because it's now 5 o'clock at night and they're going to be there for 8 or 9, maybe 8 or 9 hours. Okay. They're going to work extra overtime. So you could give them a meal. Okay. You could give them like $10 to go to Jack in the Box. So, or like I said, the payroll blows up. You could bring food in and consume it while you were fixing the problem. All right. But it doesn't happen all the time, and it cannot happen on a regular schedule. Okay. It has to be for an emergency situation. Now, the other thing that's included in here are transportation fringe benefits. And one of the things that you're allowed to do is occasionally, okay, pay for an employee's transportation if for some reason it would not she would not be able to get, or he would not be able to get home. For example, the payroll blew up and I normally take the bus home. Okay. And so it's now 11:30 at night and you say, you know what? We're just going to send you home in a cab, or we're going to call an Uber for you. Okay. Because it wouldn't be safe, and normally you would take the bus. So if you did something like that occasionally, like just once every year or something like that, that would be okay too. But you couldn't do it like every Friday. Now, there's also where you could do this if there were unusual circumstances and unsafe conditions. For example, let's say that I normally work it from 8 to 5. Okay. I leave my house at 7. I catch public transportation. I work from 8 to 5 and I catch the bus home, public transportation home. Now you want me to work from, let's say, 11 at night until 7 in the morning because we've got a special project for the next 3 months. And you need me to work at night to work on what you did during the day so it'll be available for you for the next day. Okay. So would there be any unsafe conditions here? Well, we have to look at it. Okay. When I'm leaving for work is 11 o'clock at night. So is the area around my house, could that be a crime area, or would it be consistent with a person of normal thinking saying it would not be safe? Doesn't have to be male or female, just would it be safe for a normal person to be on the street at 11 o'clock at night in that area? More than likely not. Okay. So I could pay for your ride home for that entire time. Okay. And I could pay for your ride to work that entire time. But I have to make sure that it's during the unsafe time. So I have to look at it now. So it is an unsafe condition. So I say, yes, it is an unsafe condition. But what about an unsafe time? Well, at 11 o'clock at night, that would be the unsafe time. But what about when I leave at 7 o'clock the next morning when I leave to go home? I normally leave at that time anyway to come to work. Okay. So that one I would not be able to do, because that would be the normal time I would be doing it. And I accepted the job knowing I was going to have to commute on public transportation, okay, at that time. So I must consider it safe enough because I've been doing it. But 11 o'clock at night, no, the average person would say, no, that's unsafe. So I can send a car to pick you up or pay for an Uber to pick you up, but not to take you home unless I charged you as taxable income. And again, only if you use public transportation and only if you are an hourly employee who is subject to overtime and make less than $130,000 a year. Now, also in this area are our transportation fringe benefits. Okay, the transit passes, the parking, and the riding in a commuter highway vehicle. Okay, that we're allowed to use some combination thereof. So what we can do is we can give the employee the transit passes. We can reimburse them for buying the transit passes. Okay, there's a lot of stuff that we can do here. As long as we don't go over the limits, there's no taxability. So basically the limits are $270 from this month for this year per month for transit passes. Now the state could be different. Massachusetts is a lot lower. Okay, but this is any kind of riding on mass transit. So bus, rail, metro, ferries, whatever mass transit, publicly owned, privately owned, doesn't matter, as long as mass people use it. Okay, it's not a private thing where it's just you on the boat. Okay, so I'm allowed to give you transit passes. And as long as I'm paying the right amount, it would not be taxable if it goes underneath that $270. But if I get a discount on it that nobody else gets, then I have to take that into account. And I'm going to have to use the regular price. So for example, if normally you pay 10, if you bought individual tickets and they basically cost $7.50 each, and you bought 10, you pay $7.50. But the whole entire public says, if you want to buy a packet of 10, we'll only charge you $15. So no matter who you are in that city, tourist, resident, out of towner, live in the neighborhood, it doesn't matter. The general public can buy those tickets for $15. Then I would use the $15 rate as to what would be excluded from your income. But if only I, the large company that the bus company is trying to be nice to so I can buy more passes, gives me a special discount to the $15, then I would have to look at the $17.50 as the amount that I would apply towards taxable. Neither one would be taxable, but I have to make sure I apply the right amount. Okay, so there's no substantiation that's required here if you distribute the passes yourself. So you buy them from the bus company or whatever, and you give them back, okay? Or you can reimburse the employee for buying the bus pass. So let's say Fred buys a bus pass, $100. At the end of the month, he presents his bus pass and you give him his $100. That's fine. Okay. Or Larry could buy his bus pass for $100 and he gives it to you at the beginning of the month. He certifies that he will use it, and then basically, it's okay to reimburse him at the time he presents the transit pass. And neither one would be counted income. Now, qualified parking is not that you're able to offer $270 in parking, is you can only offer $270 in parking. Okay, so and this parking only applies to at or near where the employees either park for the business or park for mass transit or carpools. All right, but you can only pay up to $270. So if you're in New York City and you pay $2,000 a month to pay park, we're talking taxable income. Okay, but we only count parking that is actually paid for, whether it's paid for as part of your building rent or whatever. That's all we count. So if you're a supermarket and your employees, or your Walmart and your employees park in the back of the parking lot, that we don't count that because that's not being paid for. Now, you are allowed to go in a highway vehicle that is considered a commuter vehicle, as long as 80% of the mileage is used for the commuting and the employees are on average in at least half the seats every day, and it has to seat at least 6 plus, not including the driver, so we need at least 7, okay, then there would be no taxation. Okay, even if you supply the vehicle, even if you supply the gas. Okay, as long as it is for commuting only. And the driver is not forced to drive. The employees can pick whoever they want to drive. You don't make any decisions as the employer. The employees make all the decisions. There wouldn't be any taxation. Now, bicycle commuting is no longer tax exempt under the Tax Cuts and Jobs Acts of 2017. So if you're supplying bicycles or anything like that, there is going to be a federal tax on that. Many of the states kept this, but the federal did not. Okay, now also under Section 132, I told you it's a catch-all. We have what we call no additional cost services. This is something I can offer to the employee and I do not have to charge them tax on it. Okay, what it means is that I have something that I offer. Now, we're not talking about buying stuff. Okay, we're not talking about like shopping at Walmart. Okay, what we're talking about is things that I do, like I'm an airline or a hotel or a cable company or a phone company, and I'm going to give what I do to my employees for free. So for example, I have airline seats and the plane's about ready to take off and there's an empty seat. Can one of my employees jump on? Yes. Now there may be some some fees involved here for the different airport fees, okay? So that, terminal fees might be involved here, or some tax, like sales tax, but not tax on wages, okay? So all I have to do is make sure that I don't incur any substantial costs, and it's my ordinary line of business, all right? So if I'm an airline, what's my ordinary line of business? Airlines, I fly people. Am I going to have any extra costs for that person sitting in that seat? No, because the plane's going anyway, and your weight is not going to affect the fuel, and nobody would eat the food. So basically, it would be fine. The same way with hotels. Nobody's going to take that room. It's 2 o'clock in the morning. You can have it. The same way with phone services. I can give you free phone service. Okay. As long as, I have a reason to do so because I happen to be the phone company. Now, I can't give you free phone service if I'm not a phone company or a cable company. If I'm Walmart, I can't give you a free phone service. Even though I might offer phone services within the Walmart store, I'm not, as Walmart, offering the phone service, okay? Now, when you do this, you can even do it with each other. For example, 2 airlines can swap seats. 2 cable companies can give you free cable. Okay, so you work for one cable company but live in the other, you can get free cable because people who work in your area and live in the other can get free cable. So as long as neither one gets any extra costs, we can do this. And hotels can do it, airlines, like I said, can do it. So it's kind of a thing where you can share as long as you're both the same business. Now, a working condition fringe is under section 132, and it basically just says something that you would pay for under the tax code as a taxpayer is not taxable because it's business related. Therefore, if your boss pays for it, we don't have to call it taxable income. So for example, this webinar would be a good example, a job related educational course. You just have to substantiate, yes, I took the course, yes, I'm in payroll, kind of thing. So it's property or services that the employee needs to perform their job. Like maybe you have a Thomson Reuters subscription, okay, to a payroll guide, or you bought an APA book, okay, or you went to ABA Congress, something like that. So it's just like an expense that would be deductible if the taxpayer did it. And if the boss pays for it, we don't bother. Okay, we also are allowed to give discounts to our employees under section 132. So this is like the Walmarts, okay? I can give you a discount because you work at Walmart. So when you shop at Walmart, I can give you 10% off if I want to. I don't have to, but I could. Unfortunately, it is not reciprocal, like with the airlines. So Walmart could not give Kmart's customers or Target's customers a discount, or Target's employees a discount. And Target couldn't give Walmart's employees a discount. Okay, that we can't do that. But we could do it for our own employees. And if it's for services, it can't be more than 20%. Now, there is a way that you have to look at the discount and everything, but most of the time it's just pretty much a flat 10%. Now, another thing that comes under this section is what we call achievement awards. And these are awards that we're going to give the employee because they've achieved some level, for like length of service or safety is what they're for. And it can only be tangible personal property. Okay, and it is limited to the dollar amounts. If you have a qualified plan, please see the IRS codes on what makes a qualified plan. $1,600 or non-qualified $400. But there must be a meaningful presentation. It can't just be I'm trying to give you extra money as disguised compensation. And it can only be tangible and personal property, again, no cash. Okay. So basically, for length of service, it has to be after 5 years. So I can't give you anything really good for year 1 through 4. I can give you de minimis ones like a pen, okay, not a Mont Blanc, okay, obviously, because that's a lot of money. But I could give you a pin that has your name on it. And then by the time you get to 5 years, there's a diamond, okay, on the 5th year. I can do something like that. I could, maybe I give you coffee cups and mugs and things like that for the first 4 years, and then you get a watch for the 5th year. Okay, so it can't be anything for the first 4 years. Okay, it has to be from the 5th year. And then safety awards cannot be given to anybody who really don't have a safety problem, like managers, administrators, clerical people, professional people. It's got to be your warehouse people, your drivers, things like that. And no more than 10% of your employees can receive a safety award. Okay, but again, we have de minimis awards that we don't worry about, like a little trophy like you see in the picture. That would be fine. But if you play safety bingo, where every week you don't have an accident, you spin the wheel and everybody gets that amount of money from like $1 to 25, that actually would be taxable income. I don't know anybody that does tax it, especially if it's only $1, but it should be taxed. Because remember, there is no de minimis on cash. Now, meals is where this gets complicated, because meals go up and down, plus and minus, back and forth. I might be able to exclude the value of the meal. Then I might have to be able to, but I might still want to deduct the meal from you. Okay. So let's look at meals overall of we're offering them. First of all, you can exclude the value of the meal if the whole reason that you're giving it to them is for your convenience and nobody else's. Okay. And there must be a substantial business reason why you are giving that meal. Okay. And because you're doing this, you may not do it for all your employees. For example, a hospital. If you're a hospital, you have 250 employees, and at least 130 of them must be on site at all times, then that would say, yes, I could furnish them a meal and not call it, okay, a taxable income, because they have to stay here for my benefit. But what about the other 120 employees? Okay, yeah, the doctors and the nurses and the orderlies and all those other people have to be there, but the payroll clerk doesn't. Well, if more than half of your employees are furnished the meals for your convenience, you can just say everybody is, because it would be virtually impossible to track. Okay, so we are allowed to do that. Now, we're also allowed to do it for food service workers. For example, you can give a waitress 2 meals each workday. You can have them eat breakfast before the shift and eat lunch on premises, so I wouldn't have to charge them for those, as long as it's during, immediately before, or immediately after their normal working hours. But it cannot be on their days off, okay, and it can't be 5 hours later. As I said, emergency workers can also get this, okay? So as I gave the example just a few minutes ago about a hospital staff, okay, you could actually do this and not have to charge any of the workers for the meals and or call it taxable income, because everybody pretty much has to stay. So many of your employees have to stay. Okay. And if it's at least more than half of your employees, then it would work. Okay. Now, if you give short meals, for example, you only get 30 minutes because of business requirements, not because you only want to give 30 or you want to go home early, and there's no place to eat in that time, yes, you could. Now, for example, on this one, I used to work at the Jet Propulsion Laboratory. So for the next 2 items, I'm going to use them as an example. When the Jet Propulsion Laboratory was first built in the 1930s, if you ever saw the movie The Martian, he talks about how the Jet Propulsion Laboratory was created by basically 4 students from Caltech they own JPL, who basically almost blew up Caltech trying to invent jet fuel. They put them out in the middle of nowhere. At that time, it was the middle of nowhere. Now it's in the middle of Pasadena, La Cañada, because it's now 75 years, 80 years later. Okay. So there was no place for them to eat. So they built a cafeteria on the Jet Propulsion Laboratory lab site. They call it the lab. Okay. Because there was no place to get food. So yes, I could have fed the employees there. But now, okay, I can't do that, because even though they would have a short meal period, let's say you only got 30 minutes, you could still drive out, get Jack in the Box, and come back in 30 minutes. Okay, because it's just right outside the lab. Plus, we have Uber Eats and all that other stuff. So short meal periods are starting to become a little more of a problem, okay, to give free meals to, because of technology coming up. And again, if there wasn't a proper meal available, then at Jet Propulsion, I could have done it. But now there are proper meals available. They can go right outside the lab and go to Denny's. They can go outside the lab and go to like 20 different restaurants. So they can have a proper meal. Therefore, I cannot give them non-taxable free meals anymore. Okay. You can give meals after hours, okay, because during the work duties, they couldn't take a meal. But what you can't do is give a good meal, a goodwill meal, meals that are just for employee morale. Okay. For example, executive lunchrooms. No, you can do it, but those meals would be taxable. And meals on non-work days, you normally cannot exclude that value when the employee is not working, except if they are also living on site. For example, cruise ships, dude ranches, where the people cannot leave. They may have the day off, okay, but they can't go anywhere. So they have to be able to eat because they can't go anywhere, okay? Now, what about operating a facility and I want to let you buy meals? Is there a problem with that? No. Let's go back to JPL. JPL has a very nice cafeteria and they have really good food. I ate there quite often. Okay. So, do they own or lease the facility? Yes, they do. So, that's one of the first criteria. Are they operating facilities on or near their business premises? Yes, they are operating it and it's actually on the lab. So, it's on their business premises. So, when can they buy food there? You can only buy food there during employee working hours. Now, they will stay open when there is a launch, depending upon the number of people that have to work for launch. But normally the cafeteria would close at 6 o'clock, okay, for the final meal period, 6 or 7 o'clock, where you can still have dinner, but that's it. They will close. The latest they really ever stayed open was like 8 or 9. But if there's a launch where they've got hundreds and hundreds of people who cannot leave the premises, okay, because they're monitoring launches, they will keep the cafeteria open. All right. So that's great. Now, what can I offer? Anything I want. All I have to do is cover the cost of the food. So if I have a hamburger and fries and a Coke, all right, typical meal at lunch for Americans. So the hamburger is a bun, meat, lettuce, tomato, secret sauce, a pickle, onions, whatever you want on there. French fries are French fries, and a Coke is a Coke. So what do I have to charge that employee? I only have to charge them enough to cover the actual cost of the hamburger, the bun, the patty, the secret sauce, cover the French fries themselves, and the Coke itself. I don't have to cover the cost of the plate or the cup or cooking the French fries or the person who served it or the person who cleans up or the rent or the gas to cook anything. I don't have to cover any of that. All I have to do is make sure they don't get free food. So if it costs me $3 for that burger, fries, and a Coke, then I only have to charge the employee $3. You know, now I doubt seriously if JPL does that, you know, because they would have to make a little bit of a profit to cover the other stuff. But they certainly aren't going to have to make the profit like Denny's does, where they've got to cover the cost of their rent. So it is cheaper. And yes, you are allowed to charge cheaper. That would not be a problem, as long as you cover the cost of the food. But I cannot give them free food. Okay, even if there's a launch, it may not be doable. Okay, because of the fact that it would not be an emergency situation. It was planned in advance. Nobody has an emergency launch of a spaceship. Okay, just doesn't work that way. All right, so but what about if they were traveling? Does it change the rules? Yes, totally. If I'm traveling on business, then I'm away from home and it's temporary, it's less than a year, then I can pay for your lodging and your food, okay, without a problem. And I can do it on a per diem basis where I give you the set dollar amount set by the US government, or I can do it on what we call an accountable plan, whereas I'm going to pay for things like your hotel, maybe I'll pay for that up front, but anything you pay for, you have to substantiate to me. Okay, if I give you money in advance, you have to return the excess you didn't spend. So meals and lodging for travel can pretty much be paid for. Now, what about lodging itself? I can actually furnish you lodging if and only if it's for my convenience as the employer. Okay, and you cannot choose additional pay instead. It must be a condition of employment. It must be on the employer's premises, and you must have it in order to do your job. So would any executive ever qualify for that? No. Executives do not have to live on site. The guy that runs the lab does not live at the lab. Okay, nobody lives at the lab at JPL. But how many apartment managers live there? They have to live there in order to do their job. How many construction security guards live there? How many people live on a boat when they're a cruise ship? So you are allowed to furnish that, okay? But they couldn't say, look, you can either live on this house or we'll give you $200 extra and you can rent someplace. Then the cost of the $200 would be taxable, but the cost of the rent would be taxable as well. All right, now let's go into transportation that isn't under Section 132. Okay, we talked about those. Mainly reimbursing for automobiles. Okay, we have two ways of doing this. We have what we call a per diem accountable plan situation. Per diems are things that are established. They don't mean per day, but that's not a bad way of describing it. The per diem for mileage is set by the IRS every year. The rest of the per diems are set by the government services. And so basically the per diem this year is 56 cents per mile. So if I were going to reimburse you for using your personal vehicle, okay, under this rule, to make it non-taxable, all I need to know is where did you go? So I need a log. All right. So I took my car and I drove to the airport to pick up the VP of Finance. It was 60 miles each way, so 120 miles round trip. I give that log to you and you reimburse me. So that is how an auto reimbursement works. I can do it for one trip. I can do it for an entire month. Okay, and then you reimburse me. It can be an ad hoc. It can be every week, but it's done the same way. It falls under per diems and accountable plans. I have to have the paperwork to reimburse you. It's very simple paperwork, but I have to have it. Now, auto allowances make this more complicated because they fall under the same rules and they must be treated the same way. So if you were having people that were using their personal vehicle for business use and you are going to pay them to do this, you have to make sure that it falls under the accountable plan. They can only be reimbursed for the amount that they actually use. You can't just give them, like, say, $500 a month and hopefully they spend that on their personal vehicle for the business use. They must prove they did. All right. In order to do that, so we're going to pick on a company called Acme, and we're going to pick on their salespeople. And they have to drive like, to 20 or 30 customers per week. And on the 15th of each month, they receive $500 to cover the business use of their personal vehicle. So on May 15th, our first guy, John Levy, would have received $500 from accounts payable. Okay. So, and that May 15th payment would be for June. So let's look to see what he did in June. Well, in June, he drove 1,268.8 miles. And if I multiply that by 56 cents, because I have to use the current one, I could have paid him $710.53. What did I pay him? I gave him $500. That's fine. Okay, we don't have to do an exact reimbursement. He agreed that he would do it for 500 and he did it for 500. Okay. So nothing is involved here. So in order to make sure that this passes the accountable plan that we need to do, we only need to look at the timing a little bit here. He has to get the money within 30 days of before he uses it. So he got it on May 15th. He was going to use it on June 1st. That's fine. He has to substantiate what he spent the money on within 60 days after the end of the event. The event ends on June 30th. So by 60 days after that, he would have to submit his log. Well, Acme requires that he submit his log before he can pick up his money again. So he would have picked up his money for July on June 15th, and he would have submitted his log for June. So he was in 15 days, so he was well within the 60 days. And if he's overpaid, he must return the excess within 120 days after the end of the event, but he wasn't overpaid. So any problems here? No. Now, let's do a second one. Joe Bumble didn't drive very much in June because he only had 2 customers to call on because he made some big sales in May. So 620 or 322.6 miles. So if we do the calculations, I was only supposed to pay him $180.66. Okay, so he owes me $319.34, has to be paid back within 120 days. So from July 1, he has 120 days, or I have to call it taxable income for July. Now, what if I don't make them submit logs? Then that's called a non-accountable plan, and basically the whole 500 is taxable. So just run it through payroll. Okay. Now, what about the personal use of a company vehicle? Well, that is taxable as well. Again, this has been in the news. By the way, the personal use of a company vehicle has been taxable since about the 1970s. It's not a new law. Okay, so what we have to do is if we give you a car, the company gives you a car, and you use that car, if you do any personal use of that car, it is taxable. And commuting is personal use. Nobody gets off with commuting, not VPs, which are always the ones that want to argue this with me. They say, well, I have to come to work, I'm the VP. I have to come to work, I'm the payroll clerk. And trust me, they would miss me more than they would miss you after every 2 weeks. You know, if when next payday gets here on Friday and you're not here and I'm not there, they're not going to miss you. You know, they're going to miss me. So it's just as important that I come to work, but you don't get a freebie for coming to work. It's not part of your job, and you don't have to have a company car to do it. You could come to work on the bus or take an Uber or buy your own car. Okay. So it is fully taxable, even commuting, unless the vehicle is non-taxable. And we'll talk about that. Now, you only get 4 different methods for taxing: general valuation, annual lease value, cents per mile, and commuting, and they are limited on some of these. But let's talk about this non-taxable vehicle. What is a non-personal use vehicle? Well, if the vehicle you're giving me happens to be a police car because you want a police car in the presence of our neighborhood, no. Or a fire vehicle, you know, like the fire chief drives around in a little truck. Maybe you're an auto dealership and you allow us to take the cars home for advertising. There are special rules for that. Maybe you don't even take the car home. Okay. Maybe what you do is you only you use it while you've got it during the day. Like say you come in, get the car, drive around, call out on the business, and you stop to pick up your dry cleaner or to pick up lunch. That would be considered de minimis and we would just ignore it. So if you're only using it during business hours, you're not commuting home with it, that's a working condition fringe and we ignore it. So how do I value a vehicle? Fair market value is usually an arm's length transaction. If it's a used car, Kelley Blue Book will find. You can fleet average if you've got at least 20 cars. If you're leasing the car, you do not use the lease value. You use the manufacturer's suggested retail price and drop off 8%, or the invoice price and add 4%. And the fair market value is always done the date the vehicle is first made available to the employee. And again, VPs of finance, they do not depreciate. If you have that car for 4 years and it was a $50,000 car today, in 4 years it's still a $50,000 car. I know that your CPA degree says that it would depreciate, but the IRS says it does not. Okay, I have this argument with VP of Finances all the time. Well, that depreciated. No, it didn't. The only time we change the value of the car is if you get a different car. So if Barbara, the VP of Finance, gets the car this year, and next year she gets a new one, and that car goes to the sales manager, then I revalue. If she still keeps that car, it's the same value. Okay. So the general valuation method basically says that the whole use is personal. There's no business use. I don't need a log. The whole thing is fully taxable. I just use the annual lease value method to determine the gross amount of your wages, and I just put them on your wages. I just tax it for everything. And you have to deduct the business use on your personal taxes, which nobody likes this method because you overpay all the taxes. There's that 2% AGI problem that's still going on. And then many people now can't even take it off because of the new Tax Cuts and Jobs Act, the way that our taxes are done. So definitely not the method you want to use unless you don't have any other choice, because the employee won't give you the doggone logbook. Okay, which is what I always threaten employees with. You don't give me the logbook that tells me how much was business use, I'm calling the whole thing taxable and going to lunch. It's less work for me. Okay. So the annual lease value gives us a table. The IRS says you determine what the annual lease value is, then you determine what the business miles are, what the personal miles are, and you only charge them the percentage that were personal miles. So I need a vehicle log because I have to know where I drove. I need the annual lease value table, which is included in the Circular E series. I think it's in A and C, I think, or B and C. Excuse me, A and B. Okay, it might also be in the Circular E itself. If they're not a full year, of course, you prorate. So basically, it includes the value of maintenance and insurance. But so if you don't provide those, you don't lower the price in any way. But it does not include fuel. So if you pay for fuel, you're going to have to give me a separate calculation for that. Either then I use the 5.5 cents per mile based on your logbook, or if they charge the fuel, I can do a percentage of the charge. I don't worry about telephones or GPS or any other specialized equipment. So the formula is the personal use miles divided by the total miles. Big number into little number, okay? I always have to tell my students that because they always want to divide the total miles by the personal use, and that gives you the wrong figure. You want to take the big total miles into the little number, okay? So let's look at a $18,000 vehicle driven 14,741 miles. 1,540 of them were for personal use. So we look on the chart and we see that the annual lease value for this particular car is $5,100. Now, if I were doing the general valuation method, $5,100 would go on as taxable income, but I'm not doing that method. So I do the math. 1,540 divided by 1,474 is 10.44%. For my VPs of finance, I always bring it out to 2 decimal places. Okay, the value of the vehicle on the table was 5,100 times 10.44%, $532.44 is taxable income. So as you can see, a big difference between the general valuation method, because remember, this is fully taxable for FIT, FICA, and FUTA. The only place that we do not tax this is Pennsylvania. They do not tax the personal vehicles. Everybody else does, but not Pennsylvania. So a little confusing. Okay, now the cents per mile method, the value of the vehicle has to be a little lower. Right now it's about $51,000, but remember, when you're doing the cents per mile method, okay, they used to have a really cheap car, like 16, 18,000, but you can't get a car for that anymore. So they had to raise it. I still need a log. It must be driven at least 10,000 miles. I charge 56 cents per mile. Okay. So basically, if I drove that 1,540 miles that I did in the first example, I would charge them $862.40. So this method is not normally used, okay, because it costs more than the annual lease value. It was much better when mileage was 20 and 30 cents. And even when it was 40 cents, but once it got into the 50s, it got more expensive. Okay, so on the cents per mile method, basically, I need the value of the meal of the vehicle, obviously, to make sure it qualifies. But I don't need anything else except a log so I know how many miles are driven. If I don't provide fuel, I can lower it by 5.5 cents per mile. Okay. So I would charge 50.5 cents instead of 56. If otherwise, for maintenance and everything else, we leave it alone. When you're doing the commuting method, I'm only going to charge you for the days you commute. But it's very restricted by the employee. It can only be done by people who must commute in the vehicle. That is not your VP of finance. That's your cable installer. In other words, I can't do my job without that vehicle. So I take my vehicle home and I go to work the next day in the vehicle because I need the vehicle. And I don't want to pay you to drive all the way in, get the vehicle, and drive all the way back out. So I'm supposed to charge them $1.50 each way or $3 a day. I don't know anybody that really does. There might be people out there that do, but it's not very common actually to do this, even though you are required to. Okay, so if I drove 280 days in a normal year, I would be taxed $840 for the entire year. Okay. Again, but it's only if they need the vehicle for business reasons, for non-compensatory business reasons. So VP of Finance doesn't qualify. And if you do have people that use the commuting method, they cannot keep personal items in the vehicle, and they cannot be a control employee, such as a VP of Finance. It's mostly for the rank and file. Now, what about personal use of a company aircraft? You say, well, Vicki, why would anybody do that? Well, you obviously live in a state that you can drive around, like California. You know, it takes a while, but you can drive from place to place. It would not be common to fly from Los Angeles to Long Beach. Just wouldn't be. You might helicopter it maybe, but you know, normally people wouldn't do that. But what about Texas, Wyoming, Alaska? Alaska doesn't even have some roads. You have to fly everywhere. So there are states where it's very common for employees to jump on the company aircraft and get flights. So under Section 61 of the Internal Revenue Code, we have two ways of valuing the personal use of a company aircraft: the general valuation and the non-commercial flight valuation rule. So the general valuation just simply means whatever the cost of that flight was, you divide it by the number of employees. Okay, so let's say you're sending all of your employees to the Bahamas, and there's 100 employees on this plane, and it costs $100. Then each employee would pay $1. That's how you do it. Now, we're not talking about flying for business. We're talking about flying as a reward or for pleasure. If you're flying to a conference, then we don't care. That's business. We're not looking at that. It's if they're flying for non-business reasons. Now, a non-commercial flight, okay, where it's you're not buying it from somebody, but you own the aircraft yourself, then you have to do it like a personal use of a company car, and you're going to have to figure it out based on the miles. So if you're renting the vehicle from the airlines, then we know what it is. Okay, but otherwise we have to do it individually. All right, and these are called what we call standard industry fare level formula, or SIFL. Okay, now this year's SIFL rates are all messed up. So I am not going to use the SIFL rates that are in effect as of July 1, because they come in each half year, because there's 3 different rates. Okay, because the airline industry was so messed up from the pandemic. So I'm going to use the ones to demonstrate this that were from the first part of this year, but the math is still the same. Okay, it's just that there are so many different rates, I didn't want it to get too confusing. So what we do is we take the mileage times each of the cents per mile rates that they give us. We use the multiplier for the aircraft size and the terminal charge. Okay, again, the Department of Transportation issues these semi-annually. So you take the SIFL rate times the mileage, then that times the aircraft multiplier, and then the terminal charge. So here's how it looks. For this period, okay, of earlier this year, for the first 500 miles was $33.85. For the next 1,000 miles, it's $25.81, and anything over 1,500 miles is $24.81. The bigger the aircraft, the bigger the percentage. So a little itty bitty Piper Cub, 15.6% for a non-control employee. If it's over 25,000 pounds, 31.3% for a non-control. Control employees, executives, are charged a lot more because it's a perk for executives, and they want to make sure executives pay for this perk. Okay, so let's look at Zelda. Zelda's a non-control employee. Let's say she's the payroll clerk. And the company plane is going to go from their office in Charleston, South Carolina to Las Vegas. Okay, to Las Vegas, Nevada. Now, Zelda asks, look, I've got family in Las Vegas and I've got friends there and I want to go for the weekend. Could I hop on the plane since it's going anyway? And the boss said, sure, go ahead. So we have to charge Zelda for that because that's a freebie. It's like giving her a plane ticket. So first thing we have to do is figure out the nautical miles. Nautical miles. Do not Google the miles from South Carolina to Las Vegas. Those are driving miles. If you don't know what it is and you can't Google it, call the airline. Okay, call the aircraft company and they will tell you what the nautical miles are, but you can just Google it. Okay, so it's 1,735 miles. So for the first 500 miles, we're going to charge $169.25. For the next 1,000 miles, $258.10, and for the last 235 miles, $58.30. Okay, so we did those calculations. Now we have a $26,000 pound, weight aircraft. It's a large aircraft, and she's a non-control employee. So we're going to add those three together and multiply it by 31.3% for the aircraft weight. That gives us 152.01. Then we have to add in the terminal charge of $61.88. We will charge her $213.89 one way. Multiply that for round trip if she took the plane home. So she ended up getting a ticket to Las Vegas round trip on a almost semi-private aircraft for less than $500. Now, what if we mix business with personal? So for example, the executive flew from New York to Los Angeles, but he has family in San Diego. So he said, oh, look, after Friday when our work is done, fly me down to San Diego from the weekend and then fly me back home. The trip to San Diego would be personal. And the difference in the nautical miles from Los Angeles to New York or San Diego to New York would be taxable as well, if there were a difference. Unless they flew back to Los Angeles, and then that's what you would charge them for. But you wouldn't charge them the flight from New York, because that was business. Okay, now what about relocation? Well, this one's really easy. As of the Tax Cuts and Jobs Act 2017, it's all taxable income. On to the next subject. Nothing you pay for relocation, nothing is non-taxable. Everything's taxable. Moving expenses, house hunting, flying the family out, whatever you're paying for, taxable income. Okay. What about third-party sick pay? Well, third-party sick pay is something you could offer your employees. It's a short-term, long-term disability. You have to give it to them in writing. You have to establish a plan for all of your employees or maybe a specific class of employees. You offer it usually through an insurance company. You might do it in-house. It's usually for temporary disability, like short-term, long-term, maybe a pregnancy, a heart attack, broken leg, things like that. It's usually expressed as a percentage of the employee's wages. But it is not SDI in California or TDI in New Jersey. Okay, this is a voluntary private plan. Now, what is the factors that I have to look at if I'm going to do and tax this and report this correctly? Well, first of all, who is offering it? Is it offered by the employer or the employer's agent? That changes the taxation. Is it offered by a third party who is not the employer's agent? That changes the taxation. Has the liability been transferred back? That changes the taxation. In other words, what has been agreed to, you need to be in on the negotiations so you know what they're agreeing to, so you know how to tax it. Because if you are the employer's agent and there are no premiums paid, you're simply paying them to administer the plan and you're covering all the costs, then everything is fully taxable, just as if you paid the wages yourself. There's no special taxation here. But if you run it through a company that is not your agent, okay, and these are the IRS terms, third party, not the employer's agent is their term. Okay, then there's an insurance risk by the third party. In other words, they're charging you premiums and they could have a loss. Then they are responsible for deducting the Social Security and the Medicare and paying the FUTA tax, okay, of all of it unless they transfer the liability for the employer portion back to you, which is what is normally done. Okay. So depends on how the plan is funded as to what becomes taxable wages. But for all the wages, if it is in the employee pays for it in after-tax contributions, what they paid for when they receive it does not get taxed. So for example, if I paid 50% of the premium through after-tax contributions, not through a cafeteria plan, but after tax, then 50% of the money that I receive would not be taxable for FIT, FICA, or FUTA. Okay. If they're both paid through a cafeteria plan or the employer pays them, that's considered employer paid whether it came out of the employee's paycheck or not, and those will be fully taxable. The only time it's not taxable for FICA is if the employee actually dies, okay? And then again, after the calendar year of death, if they go on permanent disability through Social Security, if it exceeds the Social Security wage base, or if they've been absent for at least 6 months without a single break. So they left in January and they didn't come back till October. Then after 6 months, they wouldn't tax it for FICA or FUTA anymore. If they came back even one day, we start that 6-month period over. Okay. So under these conditions, if you have a third party who is doing this, they will take out and pay the employee's Social Security and Medicare taxes. They will more than likely transfer the employer portion back to you and more than likely transfer the FUTA back to you. Now, FIT is withheld if it's the employer or the employer's agent. But if it's a third party, they only withhold if the employee requests it by submitting a W-4S form. Okay. Now, it is not subject to FIT if, again, the employee pays a portion in after-tax contribution. Okay. Or if the employee dies. So depositing the taxes all fall along the same route. If it's you or your agent, you will deposit them just as you would any other payroll. So if you're monthly, monthly. If you're semi-weekly, semi-weekly. Whatever EIN, employer identification number, is used is between you and your agent. Okay, so they might use their own, they might use yours. Okay, but if it's going to be done by you or your agent, you also are going to have to do the W-2, the W-3 if you do one, if you don't do it magnetically or on electronically. You're going to have to do a 940 and a 941. So you would simply do them the same as you do any other. You would just add them to your normal payrolls. Okay, unless the agent is doing it for you, and then you'd have to work out the details. Now, if you're doing the W-2, you can combine them on one W-2, and if you're the agent or the employer, you have to give them a W-2 even if the old thing wasn't taxable. And you just simply can do a W-2, okay, by putting it in the appropriate boxes. So you would put the sick pay in boxes 1, 3, and 5 for the wages, and any taxes withheld in 2 and 4 and 6. Okay. If anything was not taxable because it was after tax contributions, that would go in box 12, code J. Okay. And if this were a separate W-2, which you are allowed to do, you have to mark the box 13, third party sick pay. You don't mark that if it is just included with the regular W-2. Okay, now let's say it's a third party that is not your agent. Okay, then somebody's got to give a W-2. So it's either going to be you or the third party who's not your agent. So if they're going to have you do it, they must give you a sick pay statement giving you all the information, and they have to give it to you by the 15th of January. If not, then they're having to do the W-2. If they do give it to you, they do the W-2. Now, the biggest problem comes when trying to do the 941, because the money that you give for third-party sick pay, okay, if you are not the employee, if you do not have an agent, if it's not you or not your agent, the problem is that you're not going to get the whole tax amount by one person. Because remember, the third party who is not your agent is going to take out the employee's Social Security number, so employee Social Security amount. Then they're going to report it to you, and you are going to pay the employer Social Security amount, which let's say it's $100. So if you put $100 on line 5A for Social Security wages and multiply it by 12.4%, you've included the employee portion, but you didn't collect it. Okay? So what has to happen is both you and not your agent have to adjust on line 8. So you will take off the employee portion that you did not collect. They will take off the employer portion that they did not pay, and everybody's back in balance. Okay? Now, if none of the liability is transferred back to you by your agent, then you have no tax responsibilities whatsoever, and your agent will do everything. Or if it's not your agent and none of the liability has been transferred back, they will do everything. So it's whether or not the liability has been transferred back. But again, as I said earlier, I'm now going to show you a demonstration, is that you are going to have to make the adjustments on line 8, because again, we were going to put the taxable Social Security wages. I put an older 941 form in here so that we wouldn't have all the confusion with the 5II and all the other ones in here. I wanted you to see this as clear as possible. So 5A would have in here $100 times 12.4, okay, which is $12.40, but you only collected or paid $6.20, the employer portion. So you need to go down here and back out. Yes, you can have a negative on line 8. Negative basically $7.65, because you would have had $1.45 here and $6.20 on line 5A. So for the taxable Social Security wages and the taxable Medicare wages and tips, you need to bring off the employee deposit that you did not make to get you back in balance. So the practical points here are, the third party is going to request information from you. They have every reason to believe this information is correct. So if it's not their fault. You must give them the total wages that are paid during the calendar year and the last month in which the employee worked for you, and whether or not any of the contributions were made in after-tax dollars, so they can calculate the taxable wages correctly. Now, after we've closed out the payroll and you're going to do the W-2, you can only send one W-2 to the employee for third-party sick pay. So it's either on their W-2 or a separate W-2, okay? But one of you, either not your agent or you, are not going to be sending a W-2. So let's say you send the W-2 out, okay? Well, then your 941s are fine, because everything you reported as wages on line 5A is going to be on the W-2. So you balance. But the insurance company who's not your agent is now out of balance because they have no W-2 to balance. Okay, their W-2s are missing for you. So whoever doesn't file the W-2 must file an 8922 form. It used to be what we called the dummy W-2, where we just made up one and sent it in, but it goes to the IRS now. By the way, if you get a notice from the Social Security Administration that you are out of balance with your 941s, there will be a line on that notice that says, does this relate to third-party sick pay on form 8922? Yeah, they can't seem to balance these things right. So you'll have to send it in and say, yes, it is. Seen about 10 of those in the last couple of years. Not for me, but for clients. So it does seem to be a problem with them reconciling that. So just be prepared that it will, and the amount you're off is exactly the amount that's reported on the 8922 form. Okay, here's kind of a recap of what we just covered. Okay, so you know what to use. That way, I'm sure it'll be a little more helpful for you. Okay, what about healthcare? Well, healthcare, what we're doing here is we're simply reporting it. We know healthcare is non-taxable. We're just going to report it. The reporting has not changed under Obamacare, the Affordable Care Act. We're still required to do it. It doesn't mean there's any change in taxation. You're still required to put the total cost of the coverage in box 12 code double D. Okay, that was during the entire year. You get that, you have reports in your payroll system now that should be doing this. The only thing that I want to point out here, that no one is exempt from this except the U.S. military and tribal governments, because they don't do their health care the same as we do. Okay, but there is transitional relief for having to report this, which means normally that transitional relief is 250 or less in W-2s in the previous year. So the transitional relief for 2020 was 250 or less W-2s filed in 2019. What about 2021? We just did not get any transitional relief changes. So it is going to be 250 or less in 2020. However, I want to warn you that the Social Security Administration has now been given permission to lower that 250 threshold for submitting W-2s electronically. So what does that have to do with what we're talking about? Give me a minute. They're going to lower that down to 100 probably next year. They didn't have time to do it this year with the pandemic. They're going to wait till next year, from what I understand. Okay. So what's going to happen is that also affects reporting on the health insurance, because it's tied into that same W-2. So this transitional relief where you say, oh, I never have to file, I never do this because we only have 175 employees, so I never do health insurance reporting. You may have to do it next year. So be careful. Now, the healthcare, you do not have to do it if the employee would normally not be getting a W-2. In other words, they're a retired employee. Okay. So you don't have to send them a W-2, and it is not put on Form W-3 if you do send those. Now, the aggregate costs are supposed to be included, not just the employer cost. Okay, and then I've got the following slides that kind of show you what the IRS says should or should not be reported. So we want to make sure that you kind of have a list of what does need to be included, what does not, and what can be optional. Kind of just depends on how you set up your healthcare. Okay. Now, there's also other reporting of the 1094B and the 1095B that provides middle essential coverage. This is usually for the carriers or if you have your own. And the question always is, am I an applicable large employer or an ALE? Okay, so if you have an employer with 50 or more full-time employees, you're going to have an employer shared responsibility provision, and everything boils down to whether or not you are an ALE or not. So if you're self-insured or self-funded and you are an ALE, then you would fill out a 1094C and a 1095C combined, Part 3 required. If you are self-funded but you're not an ALE, then you do a 1094B and a 1095B, but Part 3 is not required. If you are not self-funded or self-insured, but you are an ALE, you would do 1094C, 1095C, Part 3 not required. And if you are not self-insured and you are not an ALE, you don't do any forms. Now, the forms are all due, okay, at the same time as the old date for the W-2s. The 1094B is the transmittal of health insurance information returns. It's filed with the IRS. The 1094C is the transmittal of the employer-provided healthcare offer and coverage. The employer files that with the IRS. The 1095B is the healthcare coverage. Okay, the copy goes to the employee and a copy goes to the IRS. The employer does that if they are self-insured. And the 1095C is the employer-provided health insurance offer and coverage return. The employer files with the employee and with the IRS. And again, they're all due basically the old due dates of the W-2, which is February 28th if on paper, March 31st if electronically, and they always extend them. So here's some additional sources for you that you might need if this is the first time you've had to do this. Okay, now we have the qualified small employer health reimbursement arrangements. This is new, okay? The maximum that you can reimburse somebody for this is $5,300 or $10,700 if they have a family. For 2021, it's reported in box 12, code F. What about educational assistance? Educational assistance is a program that you can offer that will help employees go to college. They cannot favor highly compensated employees. It can cover graduate as well as undergraduate programs, but the employee can never choose the cash instead of the benefits. It will cover the cost of books, equipment, fees, supplies, and tuition, okay, but not the cost of any tools or supplies the employee gets to keep. For example, if I need a Mac in order to do this course and you buy a Mac for me, I don't get to keep the Mac unless we call that taxable income. Okay. By the way, I want to mention right now about cell phones and laptops and tablets. Okay. I know I'm cutting into educational assistance, but this is where it normally comes in. Unless you have an employee that needs that to work from home, or like they're a cable installer and they need it or something like that, you can give your employees all the tools you want to work with. You can give them a cell phone, an iPad, or a tablet. You can give them a computer. You can set up their home office. That's not a problem. But they cannot keep the stuff. So if your employee terminates and you set up a computer in their house, they can't keep the computer unless you charge them taxable income. They can't keep the iPad or the iPhone, no matter how old it is. I always assumed that once an iPhone got to be a couple of years old, it wouldn't have any value, but it does. Okay. So you cannot let them keep anything except the books. Nobody cares about the books because they're not worth anything. Now, it also does not include meals and lodging and transportation. You say, well, why would I give my employees lodging and meals to go to school? Well, because we have internet schools now. I know several people who took their training online because they wanted to go to a particular school, but they didn't live there. Now the line training was online. But what happens is they have to fly there once or twice a semester to show up in person. So you can pay for that, but that would be taxable income. Okay. And then it's limited to 5,250 employees, $5,250 per employee per year. Now we talked about a working condition fringe, okay, that again, anything for education would also fall into this. So if you were taking an APA course, that would be working condition fringe if you were in payroll. Okay, what about prizes, awards, and gifts? This is the one that is going to cause so much pain and aggravation, it's just pathetic. People just don't get the idea that they can't get free stuff and not call it taxable income. I don't know where they got the idea the IRS wouldn't tax it, but for some reason they do. So first of all, cash is always taxable. I don't care why you gave the employee cash, it's taxable income. And so is any other type of a cash payment. Okay? So if you gave them a gift card to Amazon, let me ask you this question. Could I buy something from Amazon on my good looks alone? Are Jeff Bezos and I so close that he just lets me go out to Amazon and buy stuff without cash or a credit card or a gift certificate? No. I mean, even though Amazon and I are on a first name basis, I call it AM because they're here every day. Okay. That stuff is taxable if you buy it for me. Okay. And giving me a gift card buys it for me. But also, if I give you things that are not cash, they're going to be taxable too. So, for example, I gave you a trip or tangible personal property. I gave you a new iPad. I gave you a laptop. I sent you to Hawaii as employee of the year. Okay. It doesn't matter. It's all going to be taxable income. Even suggestion awards and employee referrals are taxable income. Okay. So it doesn't matter what you call the award. It doesn't even matter how you paid for it. So you say, well, wait. We gave her a trip to Hawaii, but we used our frequent flyer miles for the plane trip and we used our hotel points. So nobody paid for anything. Yes, you did, because there's a fair market value. That plane trip cost $800. That hotel room was $350 a night. And she was there for 7 days. Now, you have got to tax that. It doesn't even matter if it's donated by a vendor. Okay, it's got to be taxed if you gave it. So it doesn't matter if it's employee of the month, employee of the year, if it's a prize, award, a bonus, salesman of the year. It doesn't matter if it's done as a group. I know several payroll companies who take their top salespeople to Barbados every year or somewhere in the Caribbean. That's all taxable. You don't get a free Caribbean trip for nothing. Okay, that is taxable income. And our final thing we're going to talk about is gift certificates, gift cards, and things like that. I mentioned earlier in passing that every year a company I worked for gave a $25 gift certificate to the local Piggly Wiggly. Now, the reason they did that is because they wanted to give food for Thanksgiving. They wanted to give everybody a turkey. And we did attempt the turkey rule. Now, what's the turkey rule? The turkey rule says that if I give you a turkey, ham, or similar item of nominal value at a holiday time, I do not have to tax it. But the problem is I must actually give you, excuse my French, the bird. I have to give you the naked carcass with no head and the giblets with little wings and drumsticks. Okay? Little naked turkey dancing thing. I can't give you a gift certificate to go to the store to buy a naked dancing turkey. I have to actually give you the carcass. If I do that, there's no tax. And I can do it with a ham. I can do it at Thanksgiving. I can do it at Christmas. I can do it at Beelzebub's birthday if that's what I want to celebrate. Doesn't matter. I had one lady ask me one time, well, could you give them a ham at Rosh Hashanah? I said, yes, but it would be rather rude. Okay. And then she realized what she said. So, but the thing of it is, it doesn't matter whatever the holiday is you want to celebrate, as long as it's the actual that. But I can't give you the full meal. Okay. I can't give you like all the meals to it. I can just give you the turkey or ham because there's no real value to a turkey or ham except the poundage. Okay. So why can't I give you the gift certificate to a turkey or ham? Well, because I don't have to buy a turkey or ham with that gift certificate. See, that's what we originally tried to do. But the reason we couldn't give them the turkeys is because we lived in California. You can't buy a frozen turkey at 8 o'clock in the morning in California and the day before Thanksgiving and expect it not to be thawed. It's 72 degrees in San Diego. That turkey is thawed I didn't even eat turkey that year because I had to look at 275 thawed turkeys. And I'm thinking salmonella all over the place. Nobody got sick. We were careful. But we thought this isn't going to work. So the next year we gave gift certificates, but then we found out those were taxable. So then 2 years later, we finally found where Butterball Turkey used to, I don't know if they still do, but they used to give tickets for just a turkey. They would give a gift certificate that you could use at any supermarket, anywhere, for a 16-pound or 24-pound or less Butterball turkey. And then the store would build Butterball for you. Okay? So those would be acceptable. Like you could give a gift certificate to Honey Baked Hams for one ham, but you can't give them a $10 gift certificate. It's got a value to it. So all these things that you give at holidays or gift cards, gift certificates, Amazon gift cards. Okay, and then now we're going to go into holiday gifts at the holiday party. Okay, so you say, well, we have a holiday party every year and we give out lots of door prizes. Are they taxable? Actually, yes. They are. If they are only your employees win, then you would have to tax them. If you allow anybody that came to win, in other words, spouses and people that just showed up as somebody's date that they just met, you would still have to give them a 1099 if it was over $600. Okay, but you couldn't tax them obviously on anything under that. But if it was only for your employees winning, yes, you would have to. So it is a difficult situation for that. Do I know a lot of people that do it? No. I'm being honest with you. And I don't really know anybody, maybe somebody on this call might, but I don't really know anybody that does tax their gift certificates. They say, well, we're giving them a free gift certificate. We're not going to tax it. Okay, fine. But then don't come crying to me if we get audited, but we never have, so it's never been a worry. Okay, let's go ahead and take your questions.
Thank you, Vicki. Ladies and gentlemen, we are now ready for the Q&A session. If you have any questions, kindly type it in the question box. Thank you. Okay, the first question that we have is, are prizes and awards subject to 941 and 940 taxes?
Yes, anything that's taxable would be subject to all tax, FIT, FICA, FUTA, everything. State taxes as well. So anything that, unless we tell you specifically, like we talked about where third-party sick pay was sometimes not taxable, anything that's taxable is subject to all tax, yeah. Group term life insurance might be a little different because they don't tax for FUTA on that. But we didn't talk about group term life insurance today, but things like that might be a little bit in question. But the ones you're talking about, gift certificates and prizes and awards, subject to all tax, yes.
Thank you. The next one is, if we don't require an expense report for per diems, does that make them taxable?
Actually, yes, but your expense report is so simple, I don't know why you wouldn't require it. So for example, I gave you a per diem to attend a conference. The only thing my expense report has to say is, I went to a payroll conference from May 2nd to May 14th in the city of Long Beach, California, and it was held by the American Payroll Association. And I'm the payroll clerk. That's your expense report. You just have to tell them where you went and when you went. You don't have to tell them how much money you spent on each meal or what you spent on the hotel or what you even, any receipts. Not under per diems. That's accountable plan. Accountable plan, I need receipts. But under per diems, as long as I don't exceed the per diem limit established by the government itself, in other words, if it's $120, I don't go over $120 for that day, then I don't need any receipts or anything. But I do need a report saying why you went, how it was business related, and the number of days you were there. Okay, next question.
Thank you. The same attendee has further mentioned, I'm not sure if it is a part of the same question, just meals, no lodging?
Still, again, the same thing. If you give them a per diem for the meals, all they have to give you in the expense report is that they went to that conference. They don't have to tell you where they ate the meals. They don't have to tell you how much they paid for the meals. If you gave them $55 for meals and incidental expenses, which is what the limit would be in most cases, they don't have to tell you how they spent it. They could have ate $3 at Jack in the Box and kept the other $52 in their pocket to gamble. Who knows? But they have to have at least give you that basic log of why they went and where they were and for how long. And that's not too much to ask.
Thank you. Next question is, what if the company cannot remember who they gave the gift certificate to? Who would be then taxed?
The employer would still be responsible. If you give your employee a gift certificate, you are, whatever the employer does, they are responsible for. The employee is never, ever responsible for having the taxes withheld. Okay, ever. The wrong amount of taxes because they filled their W-4 out wrong and they were failed to withhold enough, that's their responsibility. But not taxing their gift certificate is your fault, not the employees. And they would never be punished for that because you have the responsibility, the fiduciary responsibility to determine what is taxable income and to withhold the appropriate tax. That is your responsibility. And if you fail in that responsibility, you will be the one that will be penalized. So if you don't remember who you gave gift certificates to, you might have a problem if you get audited. Now, remember, you have to be audited. I'm going to be honest with you here. If you're not audited, you're okay. But who knows when you're going to get an audit? Okay, especially now that the pandemic's over. And IRS is, even though they've been auditing all this time, they're now going to be out and about again. So it's going to increase the audits. But yeah, it's never the employee's fault. Okay, next question.
Thank you. So the next question is, so for the 2020 W-2s, the employer was not required to report the healthcare cost?
If they had less than 250 W-2s in 2019. Okay, then it's optional. Okay, that's what that relief is that smaller employers, okay, they don't want to have as much paperwork on them as larger employers. So they're saying if you have 250 or less W-2s, you're not required to report the Obamacare information. you could still go ahead and do it, and many of them do, because it comes off their computer system. They just went ahead and did it. Especially if you're not sure if you're going to be close or not. Maybe you have 247 W-2s. You don't want to take a chance. Okay, but the reason I mention that is because that number is going to be going down. So there are some people out there who say, well, I only have 100 W-2s. I'm not going to worry about it. And next year you may have to. But yeah, that's transitional relief. And they give it to us by the June 30th of each year. And I didn't see it come out. So it's still going to be the 250. Okay. All right. Any other questions?
Thank you. I think these are all the questions that we had for today. And if you have any closing remarks, you may please share them.
Okay. Well, as you can see, fringe benefits are tricky. We couldn't cover all of them in 90 minutes. We had to cover the highlights of them. But there's a lot more out there. You may have to do group term life insurance. You may have to do 401ks and 125 plans. There's all kinds of health insurance out there that you still might be dealing with. All of these things have to be taxed and reported correctly. If not, audits may occur. So I wish you good luck on handling all of your fringe benefits in 2021. And I'm going to turn it back over to Webinar Planet.
Thank you so much. Vicky, while you were giving the closing remarks, we received one more question. With your permission, I may ask that.
Yes.
Thank you. The question is, what if employee doesn't have enough earnings for the given pay period to cover an impute income item? Say they have $1,000 earning and get a $5,000 TV.
Okay, you can take the tax out over multiple periods if you need to. Okay, the same way you do with tips. We have that same problem when we have employees that report tip books because they don't make a whole lot. They only make like $2.13 an hour and they get $10,000 in tips. So if it's a huge gift certificate that you gave them or something huge, you could spread it out over enough payrolls. Okay, you can do that. And also remember, just out of, if I want to mention this, the IRS doesn't care who pays the taxes. If you want to pay the taxes on behalf of the employee, you can do that. You have to gross it up to cover the additional money of paying the taxes. It gets into a kind of a vicious lotus loop there, if you know what that is. But yeah, you could pay the taxes for them and then have them pay you back. And that wouldn't be taxable income to them. Or you could take it out of over multiple payrolls. That would be fine as well. Okay, any other questions?
Thank you, Vicky. These were all the questions that we had for today. Thank you so much for this amazing webinar and for answering those questions. With your permission, we may now conclude the session.
Yes, please do.
Thank you, Vicky. Ladies and gentlemen, this is the conclusion of today's webinar, Fringe Benefits Blitz for 2021, Taxing and Reporting Fringe Benefits. To disconnect, you can simply hang up. Thank you.